This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk here on this Tuesday, July 5th. Great to have you with us once again. Thanks for making us part of your day. I'm your host, Jesse Allen. Find us online, markettalkag.com. That's our home on the web, markettalkag.com. Find all of our radio affiliates there, streaming sources, and much more. It's all online, markettalkag.com. Well, coming back for the 4th of July holiday, we were wondering what we would see the market trade, and it has been a rough day in the markets. Once again, more continued selling pressure. We've seen it in the grain and oil seeds. We've seen it in livestock futures for the most part. We've seen it in the stock market and energies. Plenty of things to discuss. Let's say good afternoon to Brian Splitt of agmarket.net. Brian, I hope you had a good 4th of July. Coming back after that 3-day holiday weekend, we wondered what direction this market was going to go, and it has been a rough day, as I alluded to, pretty much across the board today, Brian.
Yeah, we're 3 for 3 on 3-day weekends. Started with the Memorial Day weekend, then we had Father's Day weekend, and now 4th of July. And coming out of these 3-day weekends, it's just been a very negative sentiment each one, and we're seeing selling exacerbated by the outside market pressures. So, getting some rain in the Midwest is not why crude oil is down $10. And that market is under quite a bit of pressure. Your other products, your RBOB, which is unleaded gasoline, down nearly 40 cents a gallon. Heating oil, which would be your diesel fuel proxy, down about 35 cents a gallon. You look at some of the soft commodities, cotton limit down. So it's just been a very, very negative day in commodities as a whole, as we continue to move towards this idea of recession, interest rates going up, and inflation having potentially peaked.
Well, plenty of things to talk about, and you started with crude oil there a little bit. I know as well the dollar breaking to the upside today, 106 on the dollar, new highs there. And typically when we see that dollar going higher, that's always usually an indicator of a weight of pressure on commodities. So maybe let's start there and talk some of those outside markets. Do you feel like that was the leading reason for some of our pressure here today, Brian?
Well, it's hard to put it on the dollar. And, when you look at the dollar, we've actually been going up in the dollar index for the last year and a half. So we haven't seen that day-to-day dollar up, commodity down type of trade. So it's hard to say, well, this is, because of the dollar today. We did trade to new highs for the move up right around 106.50, which is the highest the dollar's been since 2002. So it's been 20 years since we've had the dollar at these levels. So yes, maybe after breaking out of some recent highs, that kind of brought some new buying in the dollar and some selling in commodities. But we've had a lot of gains in the dollar in the last year and a half, and seen commodities go up during a large portion of that time frame.
Well, looking as well here as we dive into the grains a little bit, we've had the USDA reports out of the way now. We've had a lot of different things hit the market, and we've really seen the markets under pressure the last couple of weeks. Let's start with corn. I know corn, new crop contracts back below 6 now. I know we've done a lot of chart damage here, Brian. What are your thoughts with the corn market first, and just where things stand currently now as we get into the month of July?
Right. So we've done chart damage. The area that when we do our technical webinars every Wednesday, the area that we were really concerned about was the 682 low in December corn that was made on June 1st, and kind of using the cotton market as the potential roadmap. Once we took out those early June lows in cotton, it was just really an absolute bloodbath to the downside. And so It's been very much the same in corn. When we took out that June low of 682, we went racing to new lows. We never could get back above that 682 level. That was very strong resistance. We had the report last week, really a neutral type of a report. Stocks were right square where the trade was looking for them to be. The acres were pretty spot on for the pre-report estimates. But one thing that is a concern is just the increase in stocks year over year, especially on farm stocks. So here we broke through the 200-day moving average to finish the week last week, broke through $6 today. And we actually went down and filled a gap that was left back in February, early February. We had gapped higher from February 3rd to I think February 7th or so in that time frame. And that gap was filled at 574.25. So one major downside objective we've gone and hit. So now we've got some gaps above the market that will be some recovery targets, and mainly the one that was left this morning.
How about on the soybean side? Kind of the same thing here, and that was the leader to the downside today. We've seen products, meal and oil back down heavy as well. As you look at the charts there, Brian, and look at the, just the feeling in the soybean market overall, what do you see there?
Very similar. You look at corn, we talked about the June low. Taking out the June low was the same result in soybeans. And then our concern was then after taking the June low, the April 1st low. And that was the low at 1394 that was made the day after the March planting intentions and quarterly stock report. And my sentiment on our technical webinars was if you take that low out, that would actually measure all the way down to about 1211 and a half. And so this may have still some more downside yet to it. I would not be surprised at all to see beans bounce and maybe even close to $1. I do think as we get into next week, and we're going to have a WASDE report next week. And so if we take these acres that we got on the report last week and put that into the balance sheet, which is what the USDA will do, I think they'll still use a trend line yield. So unless they really take a cut to demand, which I think they'll probably cut a little bit, but even without a demand cut, you just take the production off the top of the balance sheet that we would see from the revision lower in acres, puts new crop carryout down around 150 million bushels. So maybe they cut demand and inflate that number a little bit, but we really don't have any room to lose bean yield. You start talking a half a bushel per acre and we're down in the low 100s for carryout. So really right now, I would expect USDA to show some demand revisions, but if there's any hint at lowering bean yield, I think this bean market's going to respond. We've got a gap to fill up in that 1390 area. I think that could be a potential target short term going into this report next week or maybe on the report. But again, big picture, I do think we've got lower values yet.
Well, now with corn and beans, obviously the month of July, a big month for the corn crop with pollination. Beans, August is typically the month on the weather side, and we think about just all the liquidation effort, the specs getting out of their long positions, everything that's been seen. Obviously, it feels like, it's really just leaving us with the weather market now for the most part. As we get into this month, I know we're watching those long-range forecasts, but do you think if we do go hot and dry, that would be probably the one thing that could give us some bullish momentum in corn and beans here, Brian?
Yes, and I do think that if it is something materializes later this month, it will be more of a bean led type of a move. And not to say that some hot and dry later in the month or early in August won't have an effect on corn yield, but at least by then it's going to have pollinated and we'll be into the kernel fill stage. The soybean crop is, as you had mentioned, made during the month of August first and foremost, and so I think if there is a weather market that does develop again, it's going to be led by soybeans. Now, one of the things that we look at when we're looking at these weather forecasts, and you think back to 2 weeks ago, we were supposed to be hot and dry right now. And so I think you have to be very careful about looking at the models, looking ahead 2 to 3 weeks out, saying we could go dry again, because that just has not been how they've performed. So at least how the weather models are performing right now, if it does put a forecast in of some hot and dry later, and we start to rally on that forecast 2 weeks out, that might be a selling opportunity because, again, these forecasts just have not verified for the private weather guys.
How about as well the wheat markets here, Brian? We're watching, the same things there for the most part. We've had some harvest pressure for winter wheat in the Southern Plains, Central Plains. We've had our spring wheat challenges. We got the USDA numbers out of the way. We know we're going to get those resurveys in the Northern Plains, so one has to wonder if that could change some spring wheat numbers. But overall, you look at this wheat market, anything different stand out to you from quarter beans, or is it a lot of the same similar issues going on there with the liquidation?
Well, I would say that there's a little bit of a difference in the wheat and maybe specifically the soft red variety because now the funds are holding a slightly short position. So when we think liquidation, that would be pointing towards the idea that the funds are holding a long position, they're liquidating that long, and we just don't have that in the soft red wheat. Now, the hard red wheats, the funds were still holding a little bit of a long position, and that might be, where the liquidation effect would come in. But this may be a period here where you might start to see the wheat market outperform corn and soybeans relative to each other, just because, as you had mentioned, we're at that point where we're in the middle of harvest, so harvest pressure may be slowing up here. We should be looking for a harvest low as we progress a little bit further here. I think wheat's the furthest along as far as liquidation event, and again, now the funds have gotten slightly short, where we're not at that point in corn, and as far as the reproductive cycle, wheat's furthest along as it's in harvest. Corn is going to be pollinating soon. Beans are the ones that still have the most ahead of it, which leads to me where the most opportunity for a bounce, but also the most opportunity for continued declines on liquidation events. And when you look at all these markets together and just kind of think about what lows we made in 2020 and then the highs that were made this year, as of last week, wheat had already taken half of that rally back. We added those losses today. Corn today just got to about its halfway point from the 2020 lows to the highs that were made this year. Beans still have about $1 to go to get to that halfway point.
Looking as well with these markets, what about the cash side? Let's talk about that a little bit, Brian. I know haven't seen any deliveries on those July contracts, the corn, beans, meal, oil, which, we're not surprised there. Either farmers don't have it or they're hanging on to it. It appears they don't want to put any more cash in the bank. But, I know we're watching the cash markets closely. Will we see the cash markets erode quickly along with the futures? What's your thoughts if you take a look at basis around the country? What are you hearing? What are you seeing right now?
Well, I think from the end user perspective, they were really waiting to see how that quarterly stock report came out. And I think the message that they received was that they don't have to go and chase the old crop out of the producers' bins. Again, stocks up year over year, and not just a little bit, but up, 26% on farm. And so, that's been one of the questions is the basis and the spreads that you had mentioned, your July SEP, for example. Are we trading like this because the crop is not there? Or are we trading like this because the producer just wasn't ready to sell it? They'd already sold whatever corn they were going to sell at the prices we've seen. And so I think from the USDA report perspective, it was the latter, that the producer did have the product. It just, the bushels that were still there, they wanted to see higher prices that they hadn't seen yet. So I do think that basis is going to come under pressure. I think as we get closer to harvest, with a new crop coming online, with bushels in the bin yet, that the basis is going to have some problems, and I'm not expecting the same strength in the cash market that we've seen over the last couple months.
Brian, you made a great comment to me before we went on the air, talking just about how, the difference between marketing in an uptrending market and a downtrending market, and how you should work and view your marketing plan. And, talk about that a little bit, because as you kind of told me, it's a little more difficult to market when things are moving downward versus upward.
It is. It can be tough when you're marketing in an up market because you'll make a sale and then the next day the prices are higher and then you regret that sale. But I think values have come down to levels where we can, I think, somewhat safely say that the highs have been made. And even when we were, 20 to 30 cents off of the contract highs, some of the producers that I talked to said, well, I don't want to sell. It's a down market. Well, if the highs are in, it's going to be a down market. So are you telling me you're not going to sell now that the highs are in, so I'm not going to sell at all? And so this is going to be a sell the rally market. It's, there will be bounces, but I think the producer has to be looking at, what levels of resistance, what are my targets to try and sell against, and the mentality of selling it in a down market is different than when the market's going up every day, and what's my next target if it keeps going up. So it's going to take a little bit of a different mindset now that we're in a downward trending market instead of just going higher every session.
Brian, I want to make sure we touch on livestock before we run out of time. Front month hogs held on to some green today. Otherwise, though, it appeared everything else was kind of in the downtrend, along with stocks, grains, energies, etc. I know we got to probably assess a little bit of that 4th of July holiday demand here in the markets, but as you look at the livestock sector, cattle or hogs, I'll let you pick to start, but any thoughts you have for us there?
As far as the livestock, let's look at live cattle. I've really been focused a lot on the December live cattle contract, and our sentiment as of late has been carry puts 142, 144, two very important levels basis the December live cattle, and more out of concern about what we just saw today. Not so much that we think the fundamentals are out of line and that we should see this market go down, but concerned about the outside markets. What does beef demand look like as we get into late fall, early winter, if we are in a recession? What does the overall fund activity look like if we're in a recession? Do we start to see them go short commodities in markets where they've been long? And so that's been the recent tug of war to me, is the idea that, hey, numbers aren't going to be there by the time we get to that time frame. Yet we have the overall big picture economic concerns. And so I think that today's a great example of that. When you look at feeder cattle, we made new lows for the move in corn, aggressively so, and feeders really just have not been able to take out these highs that we've been trading against for the last couple of weeks. So regardless of the weakness in corn, the feeder market just has not been able to catch a good, strong bid and take out this resistance, and that's a concern. And frankly, I don't know what the deal was in hogs today. I really didn't pay much attention to hogs. I was focused on corn and beans quite a bit today, but it was a bright spot. I mean, you had July and August lean hogs higher, and not just higher, but sharply higher. So really bucked the trend of overall commodities. But I would not expect that to last very long if we're going to continue to see outside market pressures.
Well, and I did see, I was going to mention this, like a little over $8 jump in the midday pork cutout value. So one has to wonder if that could have been tied to it. But then again, I'm with you. I don't see it lasting here with the general risk off tone around everything else. Brian, great stuff as always. Before we run out of time, any final thoughts you have for us on this Tuesday?
Yeah, we're not at the highs anymore. Don't expect to go back up to the highs, but talk to somebody, look at a chart, figure out where some of these targets are above the market. I suspect that we should get a bounce. We're overdone to the downside. If we can get to a point where crude's not down $10, we start to get the energies to bounce. I think you'll see a little bit of a bounce in the grains. And keep that in mind in reference to where you feel your crop is. If you feel that you got some rain and your crop just got bigger, do the math, because a 30-cent break in corn with more bushels may still be in a better financial position on a per acre basis. And you got to put the pencil to paper and figure that out.
Well, if producers need some advice, I know they can reach out to you and the agmarket.net team very easily, going online, give you guys a phone call. You have the app as well for smartphones. There are a lot of ways to reach you guys, isn't there, Brian?
Yeah, our general line is 844-4AG-MARKET, so 844-424-6758. My direct line is 815-665-0463, and www.agmarket.net is the website.
Well, with that, we appreciate the time as always. Brian Splitt from agmarket.net. Thank you for joining us today, sir. Have a great week, and we'll talk to you again soon.
Back at you, Jesse. Thank you.
And that is Brian Splitt of agmarket.net. That's going to do it for the show on this Tuesday, July 5th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.